We have a quick question here from Shauna asking, what exactly is the ISM PMI data and how can we trade it? So as always, thanks for the question, Shauna. Now, PMIs, or Purchasing Managers Index, is basically just a diffusion index which aims at providing a monthly gauge of various industries across the economy. Now, in a prior video, we actually talked about the market PMI data, which is compiled by IHS Markit. And in this video, we'll discuss the similar report, which is conducted by the ISM, which is basically short for the Institute of Supply Management. And they're basically a non-profit professional association in the US. Now, the reports are usually conducted at the middle of the prior month and asks purchasing managers about their opinion about things like business activity, about things like new orders, employment, supply deliveries, inventories, prices, etc. And the respondents are asked a number of questions between 10 or 12, I think. And they're basically asked to respond on the current month's outlook. So because it is a diffusion index, it normally has a score of between 0 and 100, with a number above 50 showing that the industry respondents think that prospects have improved in this month from the prior month, and basically shows industry expansion when it's above 50. And a number below 50 shows industry contraction, where industry respondents actually think that prospects have deteriorated in this current month from the prior month. Now, the ISM report is considered as one of the most important forward-looking indicators of the economy, and can often cause substantial market moves, depending, of course, on the expectations going into the event and how the actual deviates from the expectations. Now, there's basically two prints: the ISM manufacturing PMI, and then there's the ISM non-manufacturing or services PMI. Now, manufacturing consists of well below 20% of total GDP output. So the more important print is the services one, or the non-manufacturing print, which basically accounts for the vast majority of total US GDP. Now, looking at these reports, whether it's the ISM non-manufacturing or the manufacturing print, we always need to consider these subcomponents and not only the headline print as well. And the subcomponents will be things like business activity, employment, new orders, prices paid, etc. So when we have a look at the headline number, always remember to include the subcomponents into your analysis as well. Even though the headline print normally sees the first, let's say, knee-jerk reaction in the market, the reasons for the headline print coming in below or above market expectations can be found in the subcomponents. And that can point to, an even better or far worse picture than what was depicted by the headline number itself. So we always need to take these ones into account as well. Now, a common subcomponent, for example, that is very important for us to track is the employment subcomponents. Now, services, as it consists of about 80% of total US GDP and the bulk of the workforce, the subcomponents for employment for something like services is usually a key factor and input for NFP expectations. So, for example, if the employment subcomponent for both the ISM manufacturing and the non-manufacturing both surprised, let's say, big to the upside or big to the downside, that can shift the market's expectations towards a potential upside or downside surprise for NFP. Now, the difference between this month's ISM non-manufacturing PMIs, we actually had NFP already coming out last week on Thursday, so we didn't have this data as an important input into that. But normally you'll get your manufacturing and your non-manufacturing before the NFP print, and that gives you a very good idea of where the market expectations for employment in terms of NFP will lie based on that subcomponent of the employment subcomponent. Now, for the highest conviction trading opportunities, we would essentially want all of the headline as well as the subcomponent measures basically to come in much stronger or worse than the prior, or worse than expectations. So we normally don't have expectations or polling for the employment and the new orders and the prices paid. So we normally use the headline in terms of the expectations, and then we can also look at the prior numbers versus, of course, the actual subcomponent numbers coming out. But as with all economic data, the numbers itself isn't as important as the overall market expectations and sentiment going into the event, right? So if the economy is currently booming and you're firing on all cylinders and the central bank is in a hiking cycle, for example, then one more good print would kind of be expected. and one bad print by itself would probably be neglected. And if you are currently in a very big economic rut and the bank have been cutting rates, then another bad print would also be kind of as expected. And one good print on its own would probably be neglected. But once the good data, for example, starts to show for a second month and a third month and a fourth month in a row, all pointing to better than expected prints, and we start seeing a trend, then that will have a far bigger impact in the overall market reaction, just as an example. So it really comes down to how the markets are positioned ahead of the event, what the consensus is for the numbers, and then what type of print in terms of actual deviation from the minimum and the maximum expectations would create the biggest reaction in the markets in terms of future growth prospects, because it is a leading economic indicator. Now, for more information, Shauna, on the print, you can just go to the ISM's website, Institute of Supply Management, and what you can do there, once the actual data is released in the terminal, you can actually go to the website and you can open up the actual report, the detailed report for these metrics. They can offer really great insights and a more in-depth look in exactly what these metrics show, apart from, of course, just the headline numbers. So really hope that helps. Any questions, as usual, don't hesitate to let us know.